Hello, everyone. We'll go ahead and start tonight, or right now, I guess, on chapters 8 and 9. They are on cost of capital and capital structure. Usually, when we start this section, I always ask the class, why is it that companies have to grow? It's in the world of business and the world of organizational management. It pretty well is known that companies have to grow. And I always think that's kind of an interesting question when you think about it. I don't know if any of you ever watched the movie back in the day of Wall Street with Charlie Sheen, and I can't remember this guy's name. And one of the quotes that used to be in there is greed still good, or is greed good? And there's a lot of arguments. We're not going to totally get into that. But in the past, I have had students ask about, what happens on Wall Street. And for the most part, they like to blame that never-ending greed, or the machine, feeding the machine and profits and stuff like that, and attribute it to things on Wall Street. And I always think that's interesting. When you start looking at it and you look at the end result, I always ask, well, who are the folks that are managing the mutual funds on Wall Street? Who are they serving? Who are their customers and who are their clients? And when we get to the end of this, if you can see here, these are a bunch of mutual funds that you can find. This was in my old 401k. And next to this, it has the annual rates of return, etc. And I think that's interesting. So if the mutual fund managers that we often blame for why it is businesses need to grow and they need to be profitable and stuff like that, we say it's the mutual fund managers. Well, the mutual fund managers at the end of the day are working for the investors. And who are the investors? Well, they are in fact us. So, but again, it gets into the conversation a little bit of why is it companies have to grow? And one of the answers obviously is the return on investment to the investors. And that kind of gets into the discussion of something called a principal and agency dilemma. And essentially the principal agency dilemma is when the agent is taking risks or doing something that would not be in the principal's best interest. So the CEOs and executives are doing stuff, often we assume because it's not their money, they're doing things that they wouldn't do otherwise and wouldn't do if it was their own money. So, and again, not a new dilemma whatsoever. This was first discussed and talked about in Adam Smith's The Wealth of Nations in 1776. And in there it says, when ownership is separated from management, the latter, in other words, management, will inevitably begin to neglect the interests of the former, creating dysfunction in the company. And we have numerous different types of principal agency dilemmas. We have moral hazard, and many others. But if we get back to the question, I'd like to ask you, why do you think companies have to grow? Again, almost anymore, it's just assumed that if you were running a business or a company or even a nonprofit organization, that you have to grow. And I usually ask students, if you can imagine yourself an investor or owner of a small town hamburger shop. A lot of students that know I'm from Brookings always ask me if it's Nick's Hamburgers in Brookings, and if you have never been, it's a pretty good little burger shop here in Brookings. But the question is, why does even the small town hamburger shop in Brookings, South Dakota, why do they have to grow? And I want you to think about that. The other thing I want you to ask yourself from an investment standpoint is, what happens to the hamburger shop if it's not growing? Previous cohorts talked about, from various perspectives, that, well, you have to grow because of competition. And other ones were in marketing and strategic planning. We always need to make sure we're watching out for the competitors. Another person said, even on a basic level, when a business opens its doors and is able to start turning a profit, you have other competitors that are going to, or other players in the market that are going to enter. Again, when it's heard that a profit can be made in that selling, widgets or what have you, you have others then that want to go in and do the same. And essentially, firms will enter the market until that product or service is no longer profitable, or the market essentially is saturated. One other student offered up that the reason even the small town hamburger shop would have to grow is because expenses increase by inflation every year. And even just to meet this rate, a company would have to grow. So, and sometimes even then, that's not enough. Another person in a previous cohort said, well, employees expect adjustments to their pay every year, cost of living adjustments, which is usually set to inflation or thereabouts. So hopefully that gets your mind going. And I think, again, it's just important that we ask the question, why is it businesses, why do they have to grow? So to better understand cost of capital and capital structure tonight, we are going to start with a hypothetical. Not sure if any of you work at Poet Ethanol here in South Dakota. I heard recently Jeff Broen became the CEO there. I used to use Dan Loveland, who was apparently their former CFO in my little example. So some of you may not have known, I had started a private equity company with Warren Buffett, and one day Jeff Broen gave me a call and said, tell you what, we're trying to find some money because we want to expand our operations and open up a new production facility, and we're running short on money. So Jeff contacted me, and I went and contacted Warren Buffett, and we talked a little bit and said, well, yeah, we have an extra $10 or $20 million sitting around, and if you want to start a new manufacturing facility, I suppose we could do that, and we do have the resources. So one of the first things Warren and I do is we conduct a valuation, not evaluation, evaluation of Poet to try to see what their current rate of return is, what it should be. So we use the capital asset pricing model to kind of look at the risk-reward thing compared to the earnings of Poet. And based on that information, we figured out that we could earn about 12% on our investment. Now, if Warren and I can't get that 12% return, then we're going to take our money elsewhere. So, if Jeff says, yep, that'll work, we can provide you a rate of return of around 12% or maybe even a little more, okay, that then becomes Jeff Broen or Poet's cost of capital, okay? So, again, Jeff can't get this money for free. He's got to have to pay something back. So, again, when you read your textbook, this kind of is where people get confused, is they think required rate of return and cost of capital are different things. Actually, they're the same thing, okay? So again, Warren Buffett and myself, our hedge fund or private equity firm's required rate of return, now, once we invest it with Poet, will become Poet's cost of capital. So, in how this works, we've talked about capital budgeting and we've talked about valuations. Now we're kind of going to talk about putting more of that together. So in order for Jeff to pay back that rate of return, okay, Warren and I's required rate of return, and now it's Poet's cost of capital, in order to ensure that, one of the things he has to do when they're starting this new business line or manufacturing facility is that all of those capital budgeting exercises and any capital leases and anything that they're doing has to have a required rate of return or internal rate of return or net present value that's higher than 12%. Okay. Now, any amount that when Poet's doing their capital budgeting, any amount that is above that 12% is usually called economic value added. Okay. So if we look at a manufacturing facility or production facility for Poet, their goal, they might say, is for any of their product lines or any of their facilities, that facility has to produce enough where, you know, Jeff's probably going to want some cushion. He's not going to say, wow, we need to have a rate of return of higher than 12%. He's probably going to say, we want a rate of return of like 20% on product line A. Okay. So, and again, since Warren and Mai's required rate of return is 12%, which again is Poet's cost of capital, and Poet and Jeff set what's called a hurdle rate for their capital budgeting product lines or manufacturing facilities. If they set a hurdle rate of 20%, then the economic value added in that case would be 8%, which would be 20% minus the 12%, which is the required rate of return. Whoops, forgot to change a couple of slides here, my bad. So, any amount that Jeff and Poet can return that's above Poet's cost of capital or Warren and Mai's required rate of return is again called economic value added. And this is kind of the engine of driving growth in companies. So it's important that in this case, Jeff and all the managers and directors at Poet select projects that have that higher internal rate of return or hurdle rate that's higher than any cost of capital. Now, one of the things that we find when we're trying to figure out our cost of capital or the required rate of return is that we don't just look at stock or stocks, but instead we finance companies and organizations with both debt and equity. There's two essential forms of finance in all organizations. So above here, what we see is if Jeff wanted to start a new facility and we financed it with 50% debt and 50% equity, we'd see that the required rate of return on the equity is always higher than that of debt. So if we go back to Rappaport's 7 drivers of value, one of our goals to drive value in the company is to lower the cost of capital. So it seems right here that we would likely be able to do that with just by adding debt because it has a lower required rate of return, which will lower the cost of capital. So in this case, we see that the debt used to finance this, about 50% of the project, only has a rate of return of 8%. Meanwhile, the equity or the stockholders' required rate of return is 12%. So what we do is we do some quick fun math since we're financing half the company or half the project with debt and the other half the project with equity. We just do some quick math to figure out what our internal rate of return would be. Okay? So this gives us what we call essentially is the weighted average cost of capital. Okay? So very often in a company, when its weighted average cost of capital incorporates both debt and equity, it'll be normally less than the cost would be of equity. So again, we see this in this example, it would be about 10%. Now, so if you ever think about if you were to run a company, a lot of people think they'd always like to use equity, so they weren't required to have to make those monthly or periodic payments to service the debt. And that's understandable, but sometimes what gets forgotten is even though you may not be paying a direct dividend back to the stockholders, they still need a rate of return, and there's still a cost associated with that. So what some wise financial managers will do is they will look at try to financing different projects with as much debt as possible. And later on we'll talk about there's numerous impacts to this. One of them is that the overwhelming benefit is it lowers the cost of capital. There's always a downside to that, though. It also has what's called an impact of leveraging that project. So the stockholders, we don't need as much equity to do that. So when we look at rates of return on investments, by using debt, those become leveraged because usually the payments on debt, if you imagine them to be fixed or a fixed rate, then any amount that you're receiving over that kind of goes into the company, and you have it turn into an exponential increase in your rates of return. So if we need to remember that adding debt usually lowers the cost of capital, and that's one of the things that drives value in a company. As a general rule, about 99.9% of the time, for any given entity, so let's say Daktronics or Poet, for any given entity, we have kind of a rule that the common stockholders should receive a rate of return that would be higher than that of any bondholders or debt holders. And the reason that that's pretty much a rule is if the stockholders were not receiving a larger rate of return than the debt holders, you'd ask yourself, well, why in the world would you want to be an equity holder? Because you're taking on more risk, and there's a risk of kind of losing everything. And if all else fails in bankruptcy, the debt holders get paid first. So if the stockholders are taking on more risk and they're not getting even the same rate of return as the debt holders, then why wouldn't the stockholder just sell their shares and then go and invest and get bonds of that same company? So is it, 99.9% of the time, if you were to look at the weighted average cost of capital of most businesses, you will see that the equity holders usually get paid more than the debt holders. That being said, I have seen on there's a website called That's Whack. Actually, we'll go ahead and try to look that up now. We can have all this calculated for us. Yep, somebody actually made a website called That's Whack. So in here, we make life pretty easy because the actual calculation to figure out WACC can be pretty complex. And at this point, I'm more concerned that you have a general understanding of what we use it for. So if we look up Ford Motor Company and hit calculate, we can get Ford's cost of debt and cost of equity and their total WACC. And this one is WACC. It's a negative number. So we're going to try something else here. I'm guessing what's happening is this website has been on the fritz here lately, and I'm sure there's some inputs in there that are not being calculated correctly. So let's try General Electric. Yeah, must be an input in here that's getting inputted incorrectly. So what we'd see right now, for example, is for General Electric, their cost of debt would likely be less. So I'm guessing what's happening here is this is getting inputted as a negative number, and it should be a positive number. So I'm assuming that their cost of debt would be about 1.48%, and their cost of equity right here would be around 5.20%. So if we looked at the actual amounts, so looks like General Electric finances about 89% of its operations through debt and about 10.63% from equity. If we would do a weighted average and then combined those rates of return that are required to both the debt holders and the equity holders, I'm guessing it would probably be around 2% or less, so fairly low weighted average cost of capital. And that's usually what we use to set the cost of capital in a company. So again, if we were talking Poet, Jeff Bronin would want to have a rate of return that would be higher than whatever their weighted average cost of capital is. And sometimes it can be as much as double. There have been companies, Daktronics and the Alamo Group are two companies where I've actually seen the cost of debt be higher than the cost of equity, which is very odd because, again, what should happen in a market is when your cost of debt is higher than your cost of equity, the stockholders should sell their shares and then go buy the debt because it doesn't make any sense. And what happens when that occurs is the stock price goes down. And when we think about our stock valuations, when the price goes down because we're discounting cash flows, really what's that's doing is causing the price to go down, so the rate of return is higher. So when we calculate the capital asset pricing model, we kind of do that in reverse, you would see that the discount rate that you figure out there would increase when the price is going down. So in essence, by selling the shares, the stockholders are saying, I need a higher cost of capital or a higher rate of return on my stock here. So again, debt is almost always going to have a lower rate of return than equity holders because of basically legal and financial risk. In the event of bankruptcy, the debt holders get paid before the equity holders. Because of that, their rate of return should be less, again, for any given investment. All right, so some of the factors that impact the cost of capital is 1, riskiness of earnings, okay? 2, proportion of debt to equity. The higher the amount of debt, usually, the lower the cost of capital. The over financial soundness of the firm. Firms that are more financially sound, and you can actually apply that concept to yourself as an individual. When you increase your credit score because you become financially more sound, you decrease your cost of capital, so you'd pay less if you went to borrow money for a house or to borrow money to buy a car or something like that. So, and this comes straight out of your book. If expected earnings or cash flows are volatile, I mean, there's a lot of fluctuation there, and debt is high, and the firm lacks a sound financial record, investors are going to require a much higher return for taking that increased level of risk. Okay. So, if you kind of think of the cost of capital as that same discount rate we used in both capital budgeting and when we did the stock valuations, that'll help you out a lot here. So, this is essentially the impact on those things. So when risk is high or increasing, what happens on the stock valuation is that increases the discount rate and it pushes down or decreases the intrinsic value. For the debt investor, or for the overall, that's what happens to the stock valuation. For the overall cost of capital, that increases then when the stock price goes down, that means the discount rate's going up, which tells the firm that their cost of capital is increasing. Really, you have two things happening simultaneously. Your discount rate goes up, but your stock price goes down. So it's kind of, think of it as something like correcting. Now, if the risk level is decreasing or going down, what that happens in the stock valuations is it decreases the discount rate and increases the intrinsic value. Okay, so the discount rate shrinks, it goes down. Well, what that happens then as far as cost of capital, and if you kind of think of evaluation is very much related to figuring out the cost of capital, what happens then when risk goes down is it decreases the investor's required rate of return because the stock's going up, which means the discount rate is becoming lower and lower, and it decreases the cost of capital overall. Now, this whole idea really is predicated on the idea that every project within a certain company can kind of be broken down into its own product line, almost if it was its own standalone organization. So if we think again about applying this to, say, POET, I tried to come up with a hypothetical that would hopefully explain this a little better. And you can hear my phone, so we're going to have to pause. All right, my apologies for that. So we're going to start off with a hypothetical. So we're going to say that POET wants to start a product line or a new product, and essentially it'll be an algae-based biofuel. So some questions. First, how should POET determine the cost of capital, or how should it determine the required rate of return that it needs? Now, again, the interesting thing is all these rates are the same thing. Cost of capital, hurdle rate, discount rate, required rate of return, all kind of the same thing. So, first option would be that POET could pull it from a publicly traded firm that actually is involved in algae-based biofuels. Okay? And again, they could figure that out simply by looking at the capital asset pricing model, which is also called a risk-adjusted discount rate. That's what radar is. The other thing they could do is use internal data, and your book talks about using sound managerial decision-making to adjust their current discount rate or required rate of return that they need. Okay, so let's say if POET overall has a discount rate or required rate of return of 12%, POET could ask themselves, well, we're not exactly in the business of making algae-based biofuels. We do understand some of the technology, but some of it might be a little risky. So similar to using the Ansoff matrix that we went through before, we could say, well, how much riskier is this? Are they manufacturing a new product? Is it a new product to existing suppliers, so on and so forth? And based on that, they could say, well, if our required rate of return right now is 12%, maybe we put this at 15 or 18% to adjust for the risk and some of the unknowns. So that's what your book is talking about when they say that. Another option would be to adjust the rate based on the risk of a certain division and not necessarily just overall the weighted average cost of capital of the firm. This way they could figure out if you would be a little more accurate, I guess is what I'm trying to say. So when your book talks about sound managerial judgment, you really would be asking yourself, is the project more or less risky than the organization of a whole as a whole? So a POET would ask, okay, how much do we know about algae-based biofuels? Should we add to the discount rate and increase it? Or maybe it would be less risky than the company overall. Maybe they would be able to easily get into a product line or manufacture something. Not usually, but that does happen, I suppose, once in a blue moon. So now if it's less risky than the company as a whole, the discount rate should be less for that, or the required rate of return should be less for that certain product line. So if it was less risky than the company as a whole, we'd decrease that rate. We'll get into this here in just a So, one of the questions that usually by now somebody asks is, well, wait a minute, what if we as a company are sitting on a lot of money, a lot of cash reserves, or we have a lot of retained earnings that we haven't spent with anything? Couldn't we use that to finance this new product line? And the answer is obviously, of course you can. But there's one thing that we have to talk about when it comes to those cash reserves and those retained earnings. The theory goes in finance, and your book talks about this, is that we have to assign internal sources of funds. So those retained earnings, those cash reserves, we need to assign them a cost of capital. And I think your book talks about assigning it a cost of capital that is slightly less than the rate of return or the cost of common stock. Okay? So on this example below, kind of have a chart of various costs of capital, required rates of return. We won't worry so much about the percentage on this one. But you notice that we assign this a cost of capital about 1% lower than common stock. So if you're trying to figure out the weighted average cost of capital, even those retained earnings, that money that's sitting there, has to be assigned a cost of capital. And the reason we do that is corporations and investors are not giving the agent money to just sit there. Okay? They're giving this money to move forward, to grow, and to grow. So, in essence, we have to assign then that retained earnings slightly less than common stock. Now, if the corporation, if Poet, for example, happens to be sitting on, quite a bit of money, and the world isn't static, things go up and down and are dynamic, are you always going to get a rate of return on cash reserves the same as what you could elsewhere? So could you go invest it with a stockbroker if it's sitting around so you can have a rate of return? Yes and no. In corporations, you can do that. Nonprofits, you really can't do that, or you're not supposed to do that. But the retained earnings, we assign them a cost of capital, and if we're sitting on too much, we need to pay that out in the form of a dividend to the shareholders. Okay? Now, that being said, a lot of times corporations do sit on large sums of money in the event an opportunity arises. And that means that the money they're sitting on can't necessarily be tied up in, let's say, stocks or bonds or other investment resources. In the event there's a recession or something and the value were to drop significantly. So, now that being said, typically when a company goes to start a project, they usually start with figuring out if they can pay for it with retained earnings, because that's the best way to earn that required rate of return so the company can meet its cost of capital. Second source, we get into sources here in a minute. All right. Again, normally a company will use retained earnings first before trying to go out and get more equity or money from stockholders, or they may go borrow it from a bank, or they might go out and try to get it from bond investors. So, all right. Again, the weighted average cost of capital is usually what we use actually to figure out the cost of capital about the easiest way. Now, one of the things you do have to ask yourself when you're trying to figure out as a company what your cost of capital is you need to use some sound managerial analysis. I'm going to give you an example. There was a company that had a student doing an analysis on one time, and they looked up the weighted average cost of capital and saw that the weighted average cost of capital was something like 2%. And this student knew a little more about this company and figured out, hey, there's no way that can possibly be accurate. We ran the numbers later and found out it was more like 13.8%. So now granted, that's just a student looking at a stock ticker symbol trying to figure that out. But in reality, if you are doing the analysis for your company, or maybe you're trying to acquire another company, you have to ask yourself, does this make sense? Does that number make sense? Now, the weighted average cost of capital does change as the market changes, okay? And they can change quickly. So we're trying to make sure it's in a range. And again, that's usually why the internal rate of return in capital budgeting, we want it to be usually quite a bit higher than the cost of capital. All right, we're going to go ahead and skip bond ratings and how to rate bonds. Your book talks about it. That being said, basically what you look at is what's called yield to maturity to figure out if a bond is overvalued or undervalued. Go ahead and skip pages 206 to 2010, but do read the section you should remember on page 211. In chapter, give me a second here, 19. In chapters 8 and 9, don't worry about doing any of the equations. Just read the narrative, the chapters, in order to understand the concept. If it's still not making sense, please go back, watch the video again. There's also some good videos online. Again, your goal being here that you understand this. Also, according to your book, using the capital asset pricing model is not a preferred way when trying to determine the cost of common stock. And they recommend the Gordon dividend growth formula is used more often. We didn't go through the Gordon dividend growth formula, but it's very similar to the stock valuations you did. The big difference is we would use dividends to valuate, not earnings. So that's the only difference. And again, as we've talked about before, in application, usually a financial analyst would want to use some sort of multi-factor model to determine this. I think we'll touch on the weighted average cost of capital again later on. The weighted average cost of capital, or that's WACC, is still whacked out, so I don't know if we'll be able to use that for some of the work we do in class. So here is going to be your exam review question. Poet is looking to acquiring a company that produces ethanol derived from algae. The company is called Solix Biofuels. This form of ethanol production is in its infancy, and Poet has been in business for more than 30 years. Based on that acquisition, answer the following question. Would the acquisition of Solix Biofuels likely be more risky or less risky than the current operations at Poet? 2. Would you estimate the required rate of return for this project to be higher or lower than Poet's current business lines? Then lastly, what impact would this have on the cost of capital of the firm? Increase it, decrease it? What are your thoughts? So, when we're talking about the capital structure, we're talking really about how much debt and how much equity the company should have. Now, if we really want to boil this down, we're really asking how much debt should we get? At the end of the day, That's really when we talk about capital structure, that's what we're asking. So, as you can see on this chart, typically when we look at debt to equity and we're talking about the capital structure, we're looking at a pie chart to figure out how much is the operation going to be financed with debt versus how much in equity. And I have two companies up here. First one is Daktronics and the second one is Yum Brands, and I think I talked about that on a different night of class. Daktronics, for example, as of 2011, so this hasn't been updated here lately, Daktronics was about financed with about 3/4 equity and little less than 1/4 of debt. And the next company, Yum Brands, is financed with something comparable to about 95-98% debt. Okay. The Yum Brands is a franchise company that owns like Pizza Hut, Taco Bell, all sorts of fast food type joints. And Yum Brands really does have a strategy when it comes to using debt in that manner. One of the reasons that they use that is when a company becomes very good at operating and they don't have a lot of risk of the unknown. For example, if you were to open up a Pizza Hut franchise, Pizza Hut and Yum Brands knows usually where Pizza Huts work well, how many people they have to have in the community to support it, et cetera, et cetera, et cetera. So since Yum Brands knows this and they really kind of know what they're doing pretty well, the stockholders look at that and say, well, if you know what you're doing, there's not a lot of risk of the unknown, then why don't you finance as much as you can of the operation with debt? Okay. Now, what this does in turn is it leverages the earnings. Okay. When we compare earnings to, or like return on equity, what you would find is you would have a very high return on equity for Yum Brands. So in the next graph here, we have two sets of earnings, and this is earnings before interest and taxes on the income statement. And we have one that doesn't have any debt that's used as leverage, and one that does use debt as leverage. And as you can see down here, the earnings per share of the leveraged firm is significantly higher. Okay, so again, if you kind of think of return on equity, that's the game, is they try to have as much leverage as humanly possible. So then the question becomes, well, how much debt is too much? If adding debt leverages for the equity holders their rate of return, their return on equity, then you would think the goal would be to get as much debt as humanly possible. And without some restraint, that is how we'd like to do it. But the reality is, when we start diving into this, what ends up happening with a company that takes on too much debt is the stockholders actually account for that, because, and I don't have it on this chart, I do have it on another one, leverage goes both ways. So for example, if you financed a firm with just all equity and all of a sudden the firm was no longer turning a profit, they were barely breaking even, okay, no harm, no foul. But if you have leverage and you're no longer, in other words, you have debt and you have to pay back this debt, and at a minimum you have to pay the interest expense on this debt, and you're not turning a profit, there are no additional earnings, maybe even you had a loss, well, then all of a sudden you have a negative rate of return, and in order to even just make the bank happy, you ultimately have to pay through retained earnings. Usually you have to pay off those charges at the bank. So again, leverage works both ways. When times are good and things are going awesome and you're turning a profit, wow, your return on equity is huge. Earnings grow, and they actually grow. This is a very important one, even more so because there's a tax advantage to using debt. As we can see in this, okay, look at how much we're paying in taxes in the unleveraged firm. So in 1990, for example, we were paying 40%, but because the interest expense, because of the interest expense that we're paying, we can write that off of the taxes. So in 1990 with leverage, we, even without doing anything, because you're getting some money back, you're not having to pay some money to the IRS in the form of taxes, it just increases your earnings. So there's a tax advantage to using debt as well. But again, the problem with the leverage is when times are good and things are going great, you have leverage, you even have, your earnings are even higher. But when times are bad and you're not turning a profit, well, now you're really losing money, even more so, and you owe money now to the bank, which you wouldn't have otherwise. So if we know that using debt is almost preferred, especially if you know what you're doing, and this isn't like an experiment, again, like Yum Brands, and you can leverage it, and really you'd want as much debt as humanly possible, well then that's all corporations would do, is try to get more and more and more debt. And the only way to figure out if we had an optimal level of debt, and this is a theory, the only way we have to figure out how much debt is sort of the perfect amount is called the static theory of capital structure. And the reality is we don't use this theory. It's more of just it really is a theory. It's theoretical. And what this theory is, doesn't talk about it in your book. This is in another textbook I have. But what it looks at is basically comparing the amount additional you'd earn in an offset in the event you would have to file for bankruptcy. Okay? And that's what it's comparing. And that way you can figure out the precise amount of stock, or excuse me, the precise amount of debt that you as a corporation would want to take on. Now, again, since this is a theory and almost no corporation wants to be operating comparing the cost of bankruptcy with how much debt they can take on, we don't really use that. So the next way we would have to look at this is, and this sounds more complex than it really is. The only other way to figure out how much debt to take on would be to see what happens to the stock price when you're adding debt. And what we used to do, they don't have it anymore. MSN Money, Yahoo Finance would have 10-year balance sheets so we could see how much debt was being added or taken away and paid off. And then we'd look at the stock price. Now, if a corporation like Yum Brands, for example, in the 1990s, they were taking on, or no, 2000s, they were taking on a lot of debt. And what you saw is the stock price was continuing to go higher and higher and higher and higher. Now, when we look at cost of capital, here's what that means. When you take on more debt, you decrease your cost of capital because the interest rate that you're paying on that would be less than the required rate of return on it as a stock investment. So there's one area where you're reducing your cost of capital. The other way, the other thing that happens if the stock price is rising continuously like that is it means you're shrinking the discount rate. If you're shrinking the discount rate, okay, you're decreasing your cost of capital. So it has kind of a combined effect if you're taking on more debt and your stock price is going up. So again, the cool part with this, or what you're looking for to find close to an optimal amount of debt that you would want to have in the corporation, is to see if all of a sudden the stock price takes a downturn. If the stock price takes a downturn and that discount rate goes up, here's what essentially we're saying is investors are wanting a higher rate of return because you're adding additional unneeded risk. Okay? Additional unneeded risk. So when you're raising your debt levels and the stock price is going down, you'd want to keep decreasing your debt levels until the stock price levels out. And that's what we think is kind of how to find an optimal level of debt in a nutshell. Now, if we dig into that a little bit, things kind of get interesting. For starters, we talked about earlier, and I wish I had this slide in there earlier. Well, let's start with this. There's a debate on debt and how much to take on. And the question is, does adding debt, which leverages the earnings, add value to the firm, which in turn increases the stockholders' wealth? Now, one of the ways we haven't learned about yet we can figure out how much to get is an optimal amount from other sources, be it stockholders, be it debt, etc. Again, we haven't run this model yet in class. We will later on. But that model is called EFN, or external financing needed. So really, at the end of the day, all we're doing is figuring out how much additional money we need. The problem with this model is it doesn't tell you where to get it from. It doesn't tell you whether or not to borrow it, get it from stockholders, or use your retained earnings. So we go back to the rule that you want to pick the source that has the lowest cost of capital. Now, even though debt usually is going to have a lower cost of capital than your retained earnings, most corporations, or we pretty much assume that the first option for a corporation to finance a project would be from retained earnings. Their second preferred source would be debt, and you may want to write this down for later on in your life. And then the last source would be adding additional shares of equity, which unfortunately does dilute the shares of the existing equity holders. And when you're diluting shares, you're actually decreasing the stockholders' wealth, and usually they don't like that when you do that. So again, these are probably the sources we get this from. So we can figure out how much additional financing we need. Again, the model we use is external financing needed, but it doesn't tell us where to get it from. Now, before I was showing you the firm, an unleveraged firm versus a leveraged firm, and what happens just on the income statement with this. And because of the tax advantage, usually a leveraged firm will be doing better. But I ran one more set of numbers here to show you what it would look like if we didn't receive any earnings. Maybe we just barely broke even that year. And then you have that interest that you have to pay to the bank, the interest expense, or pay to the bondholders. And ultimately, at the end of the day, you can have a negative earnings per share. Now, does that mean we go out and get $2 per share in this case from the stockholders? No, it means we burn through the retained earnings. And if we're burning through retained earnings and we're doing it just to break even, there's no additional cash flows coming in, that means you're actually decreasing the value, or the book value, of the company. So we don't want to be doing that. So what this all gets us into when we're looking at how much debt is the optimal amount to get into, we have a couple of propositions, and this is kind of an interesting story. They're from two gentlemen, and they're called M&M Propositions 1 and M&M Propositions 2. And since everybody likes M&Ms, I decided that that's what these guys that came up with these theories, this is what they look like. So there's my funny haha for the video. So again, pretty interesting story in your guidebook. It will touch on this on page 53, and I'll just kind of read. So how this story goes is two gentlemen, I believe they were mathematicians, they weren't finance professors, were asked to teach a finance class at a college or university. And well, let me just read through this. So the story goes that Miller and Modigliani were set to teach a corporate finance class for business students to fight the fact that they had no prior experience in corporate finance. When they read the material that existed about how do you determine the value of a corporation, they found that it was inconsistent. So they sat down together and they tried to figure it out. And that's when they came up with these two articles, or two propositions, excuse me. And they had those published in the American Economic Review. And again, these guys didn't quite understand finance, so it was kind of interesting. Their proposition one basically said, and think about this, because this is kind of, you can understand what their thinking was, is they said, how you finance the company and how much debt and how much equity you have should have no bearing on what somebody else would buy the corporation for, right? And wouldn't. The investor, they claim, is paying for the hard assets. So if I were to go buy Daktronics, these guys believe that what I'm buying is I would go contact the CEO of Daktronics and say, well, I want to buy everything here. I want to buy the plant, the equipment. I want to buy maybe the receivables. I want to buy everything here. And Modigliani and Miller's argument is, so stockholders aren't buying. They don't care about the side of the balance sheet where we're looking at equity and we're looking at debt. Okay? They were thinking that buying a business, you'd want the hard assets, and you say to yourself, well, yeah, that makes sense. So their proposition one is that how the debt and equity is structured in a corporation is irrelevant. The value of the firm is determined by real assets and not its capital structure. Debt and equity are irrelevant because that side of the balance sheet has nothing to do with the assets that produce the earnings. Then what happened is some folks came out and talked to Modigliani and Miller and said that the supply and demand in the equity and debt markets is what drives the price of stock, not necessarily how the capital structure or the physical assets or just the earnings. And here's what they mean by that. When I go buy, well, let's use Poet. If Poet wanted to become publicly traded, and they wanted to become publicly traded because they really wanted to expand their operations, what they would do is they would call one of the 7 big investment companies, investment firms on Wall Street and say, hey, we want to go public and we need more money to expand our operation. And then one of those firms, one of those companies would say, okay, how much money do you need? Let's say $100 million. They say, okay, so what we'll start off and do is fill out a bunch of paperwork and we'll have what's called an initial public offering. So they go ahead and do this. Poet issues out 100 million shares at $1 a share. So 100 million shares out to investors, and all these investors go and buy up all this stock. So what happened here is Poet now has $100 million, and all these investors have 100 million shares. And again, that's called an initial public offering. But the actual value that's determined in the stocks, the actual stock price, isn't largely determined by the earnings and what's going on inside the company. It's often very much determined by how much somebody else will buy those existing shares on what's called the secondary market. So if I go buy 100 shares of General Electric this afternoon, I'm buying it on the New York Stock Exchange, which is a secondary market. Okay. And if buyers outnumber sellers, the stock prices will go up and up and up. If sellers outnumber buyers, the stock price will go down and down and down. So in Proposition 1, basically what Modilogini and Miller were told is we don't determine all that information by the actual company. It's the market, the secondary market, and the buying and selling of those shares is what causes it to go up. We assume, though, it's going up because of what's happening with the earnings and internally inside the company. But the reality is an investor can buy any shares of anything for any reason they want. Okay, again, largely we assume it's because of the fundamentals, but that's not like a guarantee. So after hearing this, Modilogini and Miller got back to thinking and said, okay. So in Proposition 2, they said if debt increases in the capital structure, their belief, and this goes on to how we kind of find an optimal amount of debt to take on, they said if debt increases, investors will require a higher rate of return because the earnings will fluctuate more because you've added leverage. Okay, and there will be a wider fluctuation. So if investors are not willing to pay as much because you have too much debt, then the price is going to go down of those shares of stock. And that's basically their Proposition 2, their fundamental theory behind this. So what that produces then is some follow-on applications. And we have two of them that we'll talk about in class. The first one is the net income approach, which believes that debt decreases the cost of capital because of the tax treatment of the interest expense. This doesn't exist that because we don't pay as much, we don't pay taxes on that interest expense when we're financing our debt. There's an added advantage. So knowing this, you want to keep buying debt, and then we get into what's called the net operating income approach. And basically, it's a similar model. It just uses net operating income, but it doesn't take into account that tax benefit. Basically, what it's saying is, doesn't matter if you get equity or debt, how you finance the company has no bearing on what the value of the company actually is. So we don't really use the net operating income approach, but in application, we do use it because here's the thing. At some point in time, that interest expense that we get and we don't have to pay taxes on when you file for your taxes, if that goes away, and it almost did in 2012, there was negotiations in Congress on whether or not to get rid of that deduction. Here recently in 2017 with the new business tax plan and the restructure of our taxes in the United States, there was a little discussion, not a lot, not compared to 2012, that maybe we should do away with this tax advantage that is created when you use debt and you have an interest expense for that debt. Okay, so the reason the two approaches are often used is there is always potential that tax advantage goes away because of using debt. And if that's the case, then we kind of go back to, or we go to the net operating income approach, and that kind of goes to Modilogini and Miller's Theory 1, or Proposition 1, where at that point in time, it doesn't make any difference how you finance the company. Because if you take on more debt and you leverage the earnings, okay, we think on the flip side, equity investors will pay less for the shares of stock. In other words, the discount rate goes up, okay, which because taking on more debt is higher risk. So in that case, we get rid of the tax advantage. Then again, we go to the net operating income approach. And again, that's in a nutshell what we're trying to do is figure out how much debt we should take on. We figure that out now by pretty much watching what happens when you do take on more debt, what happens to the stock price. If it goes up, well then considering taking on more long-term debt. But if it goes down when you're taking on debt, that means you've probably crossed the threshold where investors see you taking on too much debt. And you don't want to do that because our goal is twofold, and Rappaport's 7 drivers of value. One, we want to decrease the cost of capital. Okay? And the whole meaning behind finance is to increase the wealth of the shareholder. So if taking on more debt is decreasing the stock price because the discount rate goes up, and the discount rate went up because we think it's higher risk because you've taken on more debt, then we're increasing our cost of capital, and we're decreasing the share price of stock. So we're doing two things wrong. So again, how you figure out if you should take on more debt in this day and age right now is if you either buy or sell, or I shouldn't say, if you retire your debt and the stock price either stays the same or goes down, okay, you should maybe consider taking on debt again as a means to increase that return on equity. Now, if you take on more debt and the stock price goes up, well, consider taking on more debt because you decrease your cost of capital and you increase the wealth of the shareholder. And what you're looking for is, if you can kind of imagine a plateau, you're looking for that point where the stock price starts either flatlining or going down when you're making changes to your capital structure or your levels of debt. Okay? And you're trying to find it where taking on more debt, there's a signal by investors on kind of what they want you to do. So that's that idea. And this is just we do kind of know how to find an optimal level of debt. This has to do with something else. We went through the net income approach, the net operating income approach. Net income approach is talked about on 247. And on page 248, we talk about net operating income approach. I'm not going to have you guys do the exercises where we look at like a 10-year balance sheet and then we compare to a chart of stock price, because none of the financial websites anymore give you a 10-year balance sheet that we can use to try to figure this out. When I had students do this though in the past, it was kind of fun for them, and I'd say probably about one out of every 7 or 8 students would be able to see when a corporation either bought debt or took on more debt, or they retired some of their debt and they had a significant stock price change. Either way, which again would be somewhat of an indicator, we think, that they either found an appropriate level of debt or they exceeded that threshold. So, now the one thing I want you to remember is that if the tax laws change, and they very well could, and that deduction or tax advantage for using debt goes away, which I don't think it will, because that gets into a whole other storm of macroeconomics that could just torpedo the economy. I'll try to put up some videos on banking, and when you better understand banks and debt, you understand that that's almost what our economy is built on. So if you get rid of those advantages and people and corporations quit using debt, you very quickly can cause a recession. So again, I don't know that they'll ever get rid of that law, but if they do, that changes this whole principle. At that point, you can no longer find an optimal level of debt, and one is virtually the same as the other. So at that point in time, you look strictly at the cost of capital to figure this out. All right, so here is your exam review question. In application, how does a manager or agent determine, and I have in quotes here, get this back, we have sort of an optimal capital structure. In other words, how do we determine how much debt is too much? And again, you need to explain this to me on the exam, but it's seeing what the impact of the stock price is when either you're taking on more debt or if you're retiring debt. And that should be a cue from investors at what you should continue doing. Or in a perfect world, it would show you a happy medium or an optimal level, and then you could know, unless there's another gigantic change within the company structure, you know that you should finance your operations with 35% debt or 40% debt or whatever that signal is from investors. So, next question. What major event could occur that you need to be aware of that could impact the capital structure of all firms? And the answer to that one is that tax law could go away. And all of a sudden we'd have to there would be no advantage to taking on debt because there would be no benefit from writing off the interest expense on your taxes. So we already did this, and that should be good for now. Again, my apologies for not getting to class on Wednesday night. If you have any questions at all, feel free to email me. And other than that, please watch this before our next night of class, because I'll do a fast review of these two things. But essentially, I want you to be able to ask questions if you have them, if something's not making sense, so we can move on to the next option. So have a great rest of your day or evening, depending on when you watch this.